Why you always buy at the top and sell at the bottom, the four market phases no one talks about. There's a question that quietly decides whether you build wealth or lose it. Not what you buy, but when. Same strategy. Wrong moment in the cycle, you get wiped out. Right moment, you get rich. One wrong step and every step after it is wrong. Today's book is The Financial Cycle by Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. In 2020, when the world was panicking, Oppenheimer made one of the boldest calls on Wall Street. He predicted the V-shaped recovery. And he was right. He's not just an academic. He's been in the arena for decades. Keynes famously said, "In the long run, we are all dead." People love to quote that to mock long-term thinking. But Keynes said it precisely because he studied cycles. Expansion, contraction, repeat. Understanding that rhythm might be the single most important thing for understanding how money actually works. Now, a quick comparison. Ray Dalio focuses on the massive 50 to 100-year cycles, empires rising and falling, debt supercycles, geopolitical shifts. Oppenheimer zooms in closer. His focus is the medium-term cycle of stock markets and the real economy, roughly 5 to 10 years. So the shorthand goes, for the long arc, listen to Dalio. For the rhythm you can actually act on, listen to Oppenheimer. And his framework is surprisingly simple. When the economy booms, risk appetite surges, credit expands and bubbles form. Then the bubble pops, credit contracts, asset prices crash. That wave ripples through the real economy, jobs, wages, entire industries. Here's a brutal example. From 2000 to 2007, global stock markets saw some of the strongest earnings growth in history. But investors got some of the lowest returns. Why? Because all that profit growth came from the financial sector itself, built on leverage. When the subprime crisis hit, those profits vanished. Textbook wealth destruction. Now, the part that actually matters if you're trying to grow your money. The stock market cycle. Oppenheimer breaks it into 4 phases. And most people only show up for the last one. Phase 1, despair. Investors lose faith. Volatility spikes. Recession hits. People decide stocks aren't worth anything. And prices keep falling. Since 1973, this phase has lasted about 16 months on average. But here's the key. Despair is where hope is born. It's the phase that builds the energy for a reversal. The seeds of the next bull market are planted when everyone is most afraid. Phase 2, hope. Investors start to sense the worst is over. Fear eases. The risk premium drops. Valuations recover. This phase is short, about 9 months on average. But it is the single most explosive part of the entire cycle. Average returns around 40%. And here's the brutal twist. Almost all those gains come from valuation expansion, not actual earnings growth. The news is still terrible. That's why most people miss it. The money is made when things still feel bad. Phase 3, growth. The earnings that investors bet on finally start arriving. But now people hesitate. They wait for confirmation. In the US, this phase lasts about 49 months, the longest phase. Returns are steady, around 16%, while earnings grow about 60%. The slow, patient wealth building. Not exciting, but it's the real engine. Phase 4, optimism. The gains have been so good for so long, they become irresistible. FOMO kicks in. Investors pile in. Prices surge faster than earnings. Valuations climb over 50%. Leveraged money floods the market. Euphoria sets in. This phase lasts about 23 months. And it feels amazing until it doesn't. Because this is exactly what sets up the next crash. Let me pull out the 3 insights that actually change how you behave. First, earnings growth and returns don't move together. Most profits come in the growth phase. Most returns come earlier, in the hope phase. When things are cheap, investors pay in advance for future growth. By the time the good news is obvious, the big money has already been made. Second, the hope phase delivers the highest returns, 40 to 50%. It's a confidence reversal. People say confidence is more precious than gold. In financial markets, that's literally true. Third, the optimism phase, the bull market, feels like the safest time to invest. It's actually the most dangerous. It plants the seeds of the next correction. Everyone is buying. That's the problem. So where are we now? Oppenheimer argues we're in the post-financial crisis cycle, the longest on record. It's been shaped by quantitative easing, rock-bottom bond yields, and a chain of shocks. And it's been marked by weak profit growth and ever-rising valuations. That's why U.S. stocks, especially tech, have massively outperformed. But how do you actually read where you are? For signals to watch. First, bond yields, especially medium and long-term government yields. They reflect policy, rates, and inflation expectations. When yields fall, stocks tend to do well. Rising yields aren't always bad, it depends on why they're rising and how fast. But historically, when the US 10-year yield hits 5%, that's genuinely bad for stocks. Second, interest rates. Low rates starting to rise often signal recovery, good for risk assets like stocks. High rates starting to fall may signal slowdown, time to shift toward bonds and defensives. And watch the yield curve. A normal curve slopes upward. When it flattens or inverts, danger. The curve inverted before the 2000 crash and before 2008. After inversion, recession odds spike dramatically. Third, inflation. It's not simple. Modest inflation from a low base can actually be good. It signals recession is ending. But high, fast-rising inflation, like the 1970s, crushes both stocks and bonds. It squeezes margins through higher input and labor costs. The nuance matters. Fourth, unemployment. Rising unemployment is a reliable recession signal, but it lags the market. However, extremely low unemployment is almost always present right before a bear market. When unemployment is at rock bottom and valuations are extremely high, negative returns tend to follow. That combination is a very useful warning. Now, how do you actually dance with the cycle instead of getting crushed by it? Zoom in from macro to industries and companies. Industries split into two types: cyclical and defensive. Cyclical industries, real estate, autos, steel boom first in good times and crash first in bad times. Defensive industries, food, pharma, utilities hold steady. But these lines shift over time. Technology can disrupt any category. Then, at the company level, you have value versus growth. Value companies are often unsexy, pay dividends, and get chased when markets weaken. Growth companies are the potential stars, high expected earnings, high valuations, driven by innovation. And underneath all of it is the psychological swing between bull and bear. Keynes argued that financial instability is driven by psychology. Fear and greed, optimism and despair. Herd behavior makes people chase rallies and panic sell crashes. Overconfidence makes them take too much risk at exactly the wrong time. Every investor hates bear markets because of loss aversion. But Oppenheimer says, not all bears are equal. He divides them into three types: cyclical bears, triggered by rising rates, approaching recession, falling profit expectations. Most common. Event-driven bears, triggered by shocks like war, oil price spikes, emerging market crises. Short and sharp. Structural bears, triggered by the unwinding of financial bubbles and structural imbalances. Deepest and longest. The numbers. Cyclical and event-driven bears typically fall about 30%. Structural bears fall around 50%. Event-driven bears last about 7 months. Cyclical bears average 27 months. Structural bears average 4 years. Recovery. Event-driven and cyclical bears return to previous highs within about a year. Structural bears take an average of 10 years. That's not just trivia. That's the difference between panicking and staying rational when blood is on the streets. Finally, Oppenheimer's view of the future. He's neither pure optimist nor pessimist. The hard truth. He believes we're entering an era of higher rates and lower returns. The age of cheap money is over. Developed economies face aging populations, weak productivity growth, and potentially declining earnings growth. But here's the turn. The single strongest engine of recovery and returns is technology. Tech has had the strongest profit growth since the financial crisis. And there's a deep pattern here. People consistently overestimate technology in the short run and massively underestimate it in the long run. Why? Oppenheimer gives 2 reasons. First, tech waves take forever to translate into productivity. James Watt had a working steam engine in 1774. The first commercial steam locomotive didn't appear until 1812. Britain's output per person didn't accelerate until the 1830s. 60-year lag. Second, new technology only unlocks its full power when the entire manufacturing process is restructured around it. Networks take time to build. Productivity gains come slowly, then all at once. In a falling rate environment, tech companies get an even bigger boost because their future cash flows are worth more today. That's why understanding the cycle gives you an edge, not just for timing, but for knowing what to bet on. I'm reminded of something Howard Marks, the legendary investor, said, The best way to deal with cycles is to recognize when the market has gone to an extreme and be able to take advantage of that extreme. That's the game. You can't predict the cycle. But if you understand where you are in it, despair, hope, growth, optimism, and you understand your own fear and greed, you stop being the person who buys at the top and sells at the bottom. You become the person on the other side of that trade. So here's my takeaway. The cycle is not your enemy. Your emotions are. Master those. Learn to read the signals. And the cycle becomes not something to fear, but the single greatest opportunity in investing. If this hit home, drop a like, subscribe, and share it with someone who needs to hear it. I'll see you in the next one.